Hello everyone, welcome to Atomic ACCA's exam solving series. And in this video, we are going to start off with the section C of financial reporting pre-mock exam for June 2025 session. Now, why do I start with section C? It is because we know what's predictable in this particular paper, and that is section C. For 40 marks, we know 20 marks is set somewhere around the interpretation part, and the other 20 marks around the preparation part. So, why would I put myself into a risky position where I go start with section A and B, where I don't know what's going to come up from, what syllabus area it's going to be, but I know what is there in section C, and I can prepare myself. I have prepared myself as a student really good for this particular topic. So, what I'll do first, I'll score these good marks from section C so that I can put myself in a safe position within the exam. Then I can go ahead with section A and B. This is something that I used to do in order to manage my time and stress during the exam as well. If in case you face the similar issues in the exam, you can go ahead with the same, but it's not a hardened rule that you have to do the same. If in case you feel good doing section A first, B, and then pacing up to the long questions, and if you're able to manage your time and stress in that manner, then you're good to go with that as well. So let's start with the question. Section C we have here. First one is prepare consolidated SOPL for year ended 31st December X8. That is for 17 marks. And what is our next question? Next question is for 3 marks. Yeah, 3 marks. Provide a brief explanation of IFRS sustainability standard and its importance to peasant company and stakeholders. Okay, fine. So that is a small theory question we'll do later. First, let's finish that big question over here. Okay. So on 1st April, X8 Peasant Company acquired 85% equity share capital of Rose's company. So this is the parent, this is the subsidiary, 85% shareholding, this is date of acquisition. 31st December X8 is date of reporting. Peasant also owns 35% of the Daisy company. So this is an associate since 1st June X7. First thing, let's create the group structure. So what do we need within the group structure? We need to know who is the parent company. We need to know who is the subsidiary company. We need to know when is the date of acquisition, when is the date of reporting, and how much percentage shareholding is there. Next thing, we'll just copy paste the same thing down because we have an associate company as well, and we need to write down these. Who is the parent company? Peasant. Who is the subsidiary? Rose's company. How much percentage do they have? 85 percentage. When is the date of acquisition? 1st April X8. When is the date of reporting? 31st December X8. What is the time gap between this? 8 months? No, 9 months. Don't just get into direct mind calculation thinking that okay, April is the 4th month, December is the 12th month, so 12 minus 4, 8. No, this is 1st April and 31st December X8. That means Jan, Feb, March is only over 9 months you have pending in that year. So the time gap over here is 9 months, just write it over there. Then parent again in the second scenario, it is again Peasant, associate company is Daisy company, and we have a 35% ownership over here. Date of acquisition is 1st June X7, year ending is 31st December X8. How long is the time period? Is it 6 months? No. Oh, then you might be thinking, okay, looking at the same old example from previous one, we'll add 1 to it. So is it 7 months? Again, no. Why? Because this is 1st June X7, this is 31st December X8, which means there's like a 1.5-year time gap between this. So this is not 6 months, this is not 7 months, this is 1 year and 7 months. So just keep that in mind. And anything when it goes beyond 1 year, then you can be pretty much safe about this because you don't have to do any timely calculations over here. Only when it is less than 1 year you have to be a little careful because you'll have to split the SOPL in a time proportion manner. That's called pro rata basis. So that is about it. So you don't have to be bothered about it. It's plus 1 year. Oh, that doesn't work. Okay, whatever. So let's erase it. It's more than 1 year. Now, SOPL is given for the year ended 31st December over here. For Peasant is there, for Roses is there. So we have all the things. Let's start making it. So consolidated SOPL for Peasant Co for year ended 31st December. Okay, I can't see this thing. 31st December X8. You can even copy paste it from your question as well. You can just copy paste that entire thing and put it over there. Just bold and underline it, and you can just leave it as it is. Once typing is done, I thought about it, so just sharing it to you now. I don't have to do it once again. The format will be revenue minus cost of sale equals to gross profit. After every main title, I'll just leave a line just in case when doing workings, if something extra comes up over there. Then we have distribution cost. Then we have admin expense. Then we will get the PBIT. Then I'll just leave a line. We have investment income. We have finance cost. Then we have profit before tax. Then I'll just leave a line. We have tax expense. Then we'll get profit after tax. Then we will have other comprehensive income. We have revaluation surplus under this. Then we will get the total comprehensive income. Profit after tax is one major item for me, so I'll just mark it in yellow. Total comprehensive income is another major thing for me. I'll mark it in yellow. Specific to consolidated SOPL, there's one last thing that we have to do for 1 mark. That is profit after tax. We have to attributable to split it to parent and NCI. Similarly, whenever you have an OCI part over there, you have one extra step, that is that TCI also you have to split. Now that's not going to be very complicated. Along with this profit after tax, whatever is the surplus part coming up, you just have to add it to it. And you have to be careful if in case it's only for parent or parent and NCA, then do accordingly. So that splitting part is just for 1 marks, but be careful. That's an easy 1 mark. I'll be showing towards the end of this question how to get that easy 1 mark as well. So stay tuned till the end and be careful. Don't directly go jump into the last part of this video to see how that splitting is done. You'll not understand it because there's few things that we'll do in the middle in order to get to that final solution. So it's not a bluff. Okay, don't think that I'm making you forcefully watch this video. You'll understand what I'll be doing over time. So let's begin. We have 915,000 of revenue plus 534,000. Okay, I think I'll just remove these zeros. It's too long to type. So 915,000 plus 534 into 9 by 12. Then we have negative cost of sale is 470 plus 132 into 9 by 12. One more bracket. Gross profit will be equal to the sum of these two things. Distribution cost will be negative of 68,000 plus bracket 36 into 9 by 12. Admin expense would be equal to 92 plus 34.550 into 9 by 12. PBIT will be the sum of these numbers here. Investment income will be equal to 56.5 plus 8 into 9 by 12. Finance cost will be equal to 15,000 plus 13 into 9 by 12. PBT will be equal to the sum of these numbers on top. Tax expense will be equal to negative, where is it? 51.5 plus 43 into 9 by 12. Profit after tax will be equal to the sum of these numbers. Revaluation surplus is 2,800, so that's 2.8. Total comprehensive income is equal to the sum of all these numbers. Now there was already 3 zeros. Now from my end, I made it even shorter by 3 zeros. So I'm just going to put at the beginning over here $30 and 30 from my contribution. Oh, why does that not work? I might have to put this sign dollar. 3 zeros were already there. 3 zeros I put from my end. So I just wanted to round off to make it compact so we can see it easily. If you want to do it full, you can do it full. Okay. So we have the numbers over here already. Now that is all we have. about the Daisy company, this is regarding the associates part. What I generally do as a format when multiple companies are there is I'll focus on the parent and the first major subsidiary, do all the adjustments and things related to that company alone. Once that company is done, then I'll think about the other company so that I don't have to mess it up in between. So let's start with the adjustments we have here. Already right. Okay. So first adjustment, a fair value exercise conducted on 1st April exit. What is 1st April exit? Date of acquisition of the subsidiary. Concluded that the carrying amount of Rose's company's net assets were equal to their fair value with the exception of an item of machinery, non-current asset, which had a fair value of 10 million in excess of its carrying amount. So working note number 2, this is related to fair value adjustment of subsidiary. Now, what all information is given? Just remember from our net assets working note that we do in the SOFP part. We have date of acquisition, we have date of reporting, then we have the post acquisition moment, which is basically an hit on SOPL and the retained earnings part. Now, what are we talking about? We are talking about some machine. And what are they telling about machine? It has 10 million excess in value on the date of acquisition. So there's 10 million excess in value over here. Then what are they telling? At 1st April exit, machinery had remaining life of 5 years. Depreciation is charged to cost of sale. So I need to find out from 1st April exit till date of reporting, 31st December exit. How many months are there? 9 months are there. How much depreciation would be there? That will be equal to 10 million divided by 5 years were pending multiplied by 9 months of depreciation. That's equal to 1.5. This 1.5, where would I take it? Depreciation is charged to cost of sale. So cost of sale is over here. I'll just type inside this bracket plus that depreciation also comes up here. Now, this is the key point to note, which I was telling earlier about how I'll be showing, the splitting part. What is this 1.5? Excess depreciation. Excess depreciation for whom? Excess depreciation for subsidiary. So keep in mind, whenever you're doing any adjustment related to a working note onto your SOPL, and if it is related to a subsidiary, keep a note of that. Okay. Why? I'll tell later on. So this is related to subsidiary. So I'm just keeping a note of this and I want to mark it in red color so that I see this later on. When I'm doing the splitting part, I'll just come back and easily find the figure from here. So we have this excess depreciation and that is sorted. So first paragraph is done. Second one, since acquisition Peasant Company, since acquisition means since 1st April exit, Peasant Company has sold goods to Rose's company totaling 25 million. So this is about working note number 3, intercompany sales. Now who is selling to whom? Peasant is selling to um, Rose's company. So this is parent to subsidiary. All right. What is the total sales they're doing? Total sales is equal to 25 million. And Rose's company had 1/4 of these goods in inventory. So remaining in inventory is equal to 25 million divided by 4. So 1/4 of that 6.25 million worth of sales item is there inside the warehouse of the subsidiary company. Then during the year, Peasant Company also sold goods to Daisy Company. Just keep in mind we have something related to intercompany for associate, but we're not bothering now. For the timing, we'll just keep it on hold. All of which Daisy Company held in inventory at 31st December exit. Okay, fine, no problem. Let's mark this. How do I highlight it? Okay, done. Okay, how do I remove this thing now? Okay. Okay, so that is ready. So that is something we have to deal with later on. All of these goods had a markup on cost of 35%. So markup is 35%. How do I find this? We have multiple formulas to get to this profit figure. What I always do is go with the traditional route, that is cost, which I don't know, plus 35% on that cost X will give me this 6.25 sales price. So what will be the cost? That will be equal to 6.25 divided by 1.35. Now I have the sales price, I have the cost. What do I need? I need the profit figure. That is basically the unrealized profit. What will I do? This one minus this one, I'll get this one. Now you might be thinking that there's shortcut to get to this number. Yes, there are shortcuts. But then why do I stick to this traditional method of going through the long route? Because I don't want to stuff up a lot of formulas in my head. Because I don't want to think later on in the exam Oh, is it 35 by 135, or is it 35 by 100, or is it 65 by 100, or 65 by, I don't want to get myself confused. I know this. How do I reach to the markup, and I know the margin basic format? I'll just stick to it because it's just going to take one extra second to type one more step. If I'm thinking the formula, it might take around 5 6 seconds extra, so I don't want to waste that time. I want to prioritize what works for me. Should I think a lot, or should I work on the speed? So just think what works for you, do according to that. So we have the unrealized profit over here, that is ready. What do I have to do with the unrealized profit when parent sells to subsidiary? Rule number one, whatever sales are there, you have to minus out from revenue and cost of sale. So revenue is over here, we'll minus it out, minus 25. Do I have to do 25 into 9 by 12? No. This is the total sales they did. They didn't tell that over the year it was 9 by 12. I mean, over the year it was 25 million or anything. They just told that from acquisition till the year end, they did 25 million. That means that 25 million is already for 9 months. So if you do into 9 by 12, again, it will become even smaller figure. So that will not make any sense. So be careful, just because it is a dealing with subsidiary, don't directly multiply with 9 by 12. Just see the logic behind it, whether it is something to be done or not. So did I do over here minus C22? Okay, total sales was subtracted over here, and cost of sales, I'll minus out again that 25 from here. And what do I have to do with this unrealized profit? I'll have to add it to the cost of sale. So unrealized profit is over here. I'm going to add it to the cost of sales, that is 1.62. So that's done. Now, what all adjustments we did? We did this 25 million adjustment. Who all did we do it for? We did for parent and we did for subsidiary as well. That means this is not a subsidiary adjustment alone. Leave it aside. Unrealized profit. Who is selling to whom? Parent is selling to subsidiary. So who is making the profit over here? Parent is making the profit. So whose unrealized profit did we remove from the consolidated books now? Parents. That means this is not a subsidiary adjustment. Forget it. So we're done with this paragraph as well. Let's go to next one. Investment income of Peasant Company for the year ended 31st December. Okay, parents' investment income for that particular year, that means 1st Jan to 31st December, includes dividends from Rose's company and AC company. So subsidiary and associate gave some dividends. This is an intercompany sale, so intercompany transaction, so you're supposed to remove it. See note number 4. Okay, we'll see that later on. Then it also includes 5 million interest receivable on a loan made to Rose's company on 1st April 20 exit. So okay, now we have to be a little careful on this. Let's just carefully frame this one. Working note number 4, intercompany loan. Now, parent gave some loan to subsidiary. That's why parent is having in their investment income 5 million interest receivable. Now, parents' complete figures are there in the SOPL. We didn't do any time proportionate thing. And this 5 million interest income is not supposed to be there. So you have to completely remove it. So remove, it's not working. Remove parents' income. How much? 5 million. We'll just write over there. 5 million we'll remove. How about from the subsidiaries point of view? Now this we have to be a little careful. Why? Because what is subsidiaries finance cost? Meaning they are paying interest, right? Finance cost is 13 million. So subsidiaries total finance cost is 13 million. This is for one whole year. Inside this one whole year, there is a finance cost of 5 million that came up only for 9 months. That means if I do 13 million into 9 by 12, that means I'm not only doing the whole 13 million, there is this 5 million inside this, which was already only for 9 months, this time gap. Let's just frame it like this. Let's say this whole thing is 1 year. Inside this for 9 months, this is that 5 million. Okay, now when I say 13 million into 9 by 12, what is 13 million? 13 million is like the closing balance at this figure, meaning it is including that 5 million. So what am I doing over here? When I'm in multiplying that 13 million into 9 by 12, what I'm in total doing is this 5 million which is inside that also I am multiplying into 9 by 12, but in fact that figure was already only for 9 months, that was not for the whole 1 year. So what I'm doing is that 9 months item I'm multiplying again by 9 by 12, so that will go wrong over here. So what I will have to do is, if I want to remove this impact of finance cost from that particular element, from this 13 million, this is 13 million, okay, I'll just write over here. From this 13 million, I will remove that 5 million. If I remove this 5 million completely from that 13 million, what is remaining for that entire year? What remains for the entire year is 13 minus 5 is equal to 8 million. So without that 5 million impact, 8 million was the actual finance cost subsidiary had in that particular year. Now this 8 million I can multiply with 9 by 12, because only for this 9 months that was part of my group company. Before that 3 months it was solo company. So this is the adjustment we have to do. We are going to remove subsidiaries finance cost by 5 million, but unlike the other adjustment we did, we are not going to remove it directly from the last adjustment. I'll just show it over here. Have the finance cost over here, this 13 million. Now I showed the adjustment over there what we are doing, so you can just understand from here. This 13 million I will make it to 8 million. Basically that 13 million, 5 million I'm reducing from that and making it to 8 million. So that 5 million I remove from there, finance cost adjustment I did. And the other adjustment is parents income I have to remove. So where is investment income? Investment income is over here, minus 5 million. Now this 5, should I remove it from this 8 over here? No. Why? Because that 8 is of subsidiary. This 5 is investment income for the parent. So parent's full figure is there. Like throughout the time period before or after acquisition, parent is parent itself. Full time period figure is there. So you don't have to do any complicated thinking over there. Just remove that 5 million as it is. So basically this 5 million I'm removing from this 56.5 million, making it to 51.5 million. So we did the adjustment for this one and this one. Now again look at the figures. We removed 5 million investment income. We removed 5 million finance cost. Is this anything specific to parent alone? No. But here with finance cost, something related to subsidiary, there was an adjustment we did. And this subsidiary's finance cost is a little complicated adjustment over here. What we can do is we'll just keep a note of this and see if this is of any use for our splitting calculation later on. So I'm just going to mark this in red. I don't know yet whether I'll have to use it or not. When doing the split part, we'll see to that. So intercompany loan is also done. Now about the dividend, intercompany dividends. Working note number 5. Intercompany dividends. Okay. So investment income, they are telling that Rose's investment income of parent includes dividend from Rose's company mentioned in note number 4. Now Roses is the subsidiary. Subsidiary paid a dividend. Paid dividend of 13 million on 31st December exit. Then Daisy company, that is the associate company, paid a dividend of 29 million. I just wrote the information. I'm not dealing with the associate for now. But here one complication that arises in the understanding part is Rose's company was owned 85% by the Peasant company. So they're not clearly indicating whether this 13 million is only for Peasant company or is it for the Peasant company plus the NCI. They're not giving the exact idea over here, because you can interpret in either ways. If you want to say that this is completely for Peasant company, that is also justifiable, because they told that investment income of Peasant company includes the dividend from Rose's company as mentioned in note number 4. So what is mentioned in note number 4? Rose's company paid 13 million. So that's directly justifiable, stating that this amount is completely for parent company. I don't have to multiply with 85%. But I can justify the other one also. They told Rose's company paid a dividend to the shareholders. Rose's company is not 100% owned by Peasant company. There's a 15% NCI also, who is also the shareholder of Rose's company. So if I'm justifying that way, I can say that 13 million completely is not for Peasant Company. It's only 85% of that. Whichever justification you're going with, because this is a vague situation over here, what you can do is, whatever calculation you're doing, just write to the side of this, like assuming this is the situation. For example, if you want to go with the full figure, then write over here, assuming this figure is completely paid to Peasant Company. If in case you're going with the other way around, let's say equals to 13 million multiplied by 85 percentage, then you can just write over here, assuming this figure is the whole, assuming what is the total figure, assuming 13 million is the total dividends paid to Peasant Company and NCI shareholders. So whatever is the assumption that you're going with, just maintain that. Okay, don't assume like this one will be 85% and this one will be full 100%. Don't go with that. Either take percentage for both or don't take percentage for both. So think from that point of view, then write your assumption to the side so that the examiner gets to know what was your thought process behind that calculation. So there's a transparency in this. So since I wrote this thing, I'll just go ahead with this. And this one also, I just, okay, for the time being, I'm not doing any adjustment. Let's keep it as it is. So subsidiary paid 11.05 million. Now, what will be subsidiary's entry over this? Will it be an expense for subsidiary? No. Subsidiary paid it out of their retained earnings. So that's an adjustment in SOFP. How about in SOPL? What is the impact? This is included inside parents' investment income. So what I have to do? I have to remove it from there. So where is parents' investment income? Over here. What I have to do? I have to remove it. Negative 11.05. Is this an adjustment about subsidiary? No, this is an adjustment about parents investment income, so nothing that will be related to our splitting part later on. So that is done. Then this paragraph is over. All items in above profit or loss and other comprehensive income deemed to accrue evenly over there. That's like a default assumption. Even if the statement is not given, you have to take as it is. Now we are done with the subsidiaries part. Now let's do with the associates part. Anyways, we stopped over here, so let's start from here itself. What did associate pay? 29 million. Since we went with the percentage thing, we can just go with 35 percentage was paid to parent company. So what am I going to write over here? Assuming what was the total figure? 29 million. Assuming 29 million is the total dividends paid to Peasant Company and other shareholders, because not NCI shareholder here, NCI is us. Okay, the 65% majority parent is someone else. So just write other shareholders, write your wordings correctly. So we have this, and what we have to do, we have to minus it out from the investment income. So this one minus investment income 10.15. So that is ready. So this adjustment is over. Then we had something about intercompany sale. Do I have a space over here? Intercompany sale. I'll just, okay, I can pull this down. So the other one is parent to associate. Parent to associate, they are telling that the total sales is equal to 26 million. Now okay, now unlike this 25 million, should I remove it from revenue and cost of sale? No, because this is an associate is not consolidated altogether, so you don't have to do that. So this 26 million you don't have to do. Then all of which is still remaining in the inventory. So what is remaining in inventory? Remaining inventory is complete 26 million. Then again I have to now calculate what is the unrealized profit in this. So I need some more space. Unrealized profit calculation, I'm just going to copy the same thing once again, so my work gets a little easier. Markup is 35%, x plus 35%, it will be 26 million. So x will be equal to 26 divided by 1.35, that's 19 million. So unrealized profit is 6.74. Does it end over here? No, because whenever you're doing unrealized profit for subsidiary, we took as it is, because the complete subsidiary, regardless of whatever percentage shareholding you have, you took the 100% revenue, 100% cost of sale, 100% expenses, income, everything you added 100%. Keep in mind, I'm not talking about time period, I'm talking about percentage shareholding. So even though I own only 85% in that company, I took the entire subsidiaries figures over here, full 100%. That is the reason why when I took unrealized profit over here, I didn't do into 85% or anything. I took the full 100%. But when we are talking about associate company, I don't take up 100% figure from the associate and consolidated. Rather, I take only the 35 percentage profit share of the associate and add it inside my SOPL. Because of which, whatever unrealized profit that I have, I am going to take only 35% out of this and not the 100% out of it. So what will be 35% of this? It will be equal to this one into 35%. That is 2.35925 whatever, and this unrealized profit I'm supposed to add it to the cost of sales. So this is the adjustment that I have to do to the cost of sale. I am going to add the amount, so unrealized profit, not 6.7, the other one, okay, 2.35. This number I'll add over here. Whose adjustment this is? 2.35. This is the parent's adjustment. So do I have to mark it in red color for my splitting calculation? No. So we're done with this adjustment also, and with that we're done with the complete adjustment over here. So all of our figures are done. Now comes the final part, that is the splitting calculation. How do I have to do the splitting calculation? I'll just write over here, or maybe I can write at the bottom. Splitting of profits. Now what is the step number 1 for splitting of profits? I'm going to start with taking the subsidiaries profit over here. Oh, one more thing I forgot to do. There is this associates profit. Okay, associate has a total profit of 113,040, and into 35% we're supposed to add it over here. I think I didn't do it, so I have one line over here, so I'll just write uh, parents percentage of associates profit. So I don't have the space over here, so I'm just going to write as it is. I'll just expand this one. That will be equal to 113.05 into 35 percentage. Do I have to take into 9 by 12? No, 9 by 12 was for subsidiary. That means should I take into 7 by 12? No. Into 6 by 12? No. Because I explained this earlier, the time gap is not 6 months or 7 months. This is one plus year, 1 year and 7 months. So you don't have to bother about the time period. Just look at the percentage. So 113.05. Did I write it correct? 113.05. Okay. So we got all the numbers over here. Now let's do the splitting part. Splitting of profits. First, subsidiaries profit. How much is the subsidiaries profit? Let's do the profit for the year first. That is 283,450. So that is equal to 283.450. Now this 283.450. Now what all do I have to adjust over here? Let's look at the red color ones. Only the red color ones. You don't have to bother anything else. One is this post acquisition was there. This is extra depreciation. So that I'll have to reduce from the profit. What about this red color one? What do I have to do with the finance cost part? Why this is important over here is this 5 million finance cost was only there for 9 months, correct? So this was only there for 9 months. This is whole year's profit. Inside this, there is a 5 million finance cost that was only there for 9 months. Now, if in case I do 283,000 into this 283.45 into 9 by 12, this will happen like the same scenario once again. I'll just copy paste it. I'll explain. This is the whole profit, 283.45. Inside this, there is a negative 5, that is finance cost expenses there. If 283.45, if I multiply into 9 by 12, what happens is this expense inside this of 5 million, which is already only for 9 months, that gets also multiplied into 9 by 12 once again. So what I have to do is that expense, I will just pull it outside, then see what is the remaining actual profit for the entire year. In that case, from 283.45, if I move away this 5 million expense, what will I have pending? This one plus this one. That will be I'll have 288,000. How did it increase? Because 283 is profit, 5 million is expense. So when I move away expense, my profit will go up. So I have 288.45 actual profit for the entire year. This 288.45 that I'll just write to here, 283.45 plus 5 million. So 288.45 is my actual expense. I'm sorry, actual profit for the entire year. Now, out of this, minus 1.5 million is what? 9 months of depreciation. Now be careful over here. A common mistake that most people do is, let's say, reduce depreciation. So if I take this equal to and take over here, then I'll just show the calculation. This one minus this one. If I do this one, now I reduce the depreciation. Now this was full year profit. I minused out the depreciation. I got this one. And now I want for 9 months. So if I take this one into 9 by 12. Now what happened over here is I took, oh sorry, not 9 by 12. Yeah, 9 by 12. And one more thing is that I want the NCI figure out of this. How much is NCI percentage? 15 percentage. Okay. Now here what has happened is this profit was for full year. Okay. I minused out 9 months of depreciation from this. Then I got a profit figure. This one, when I multiplied with 9 by 12 once again, what happened over here is a depreciation inside this. That 9 by 12, 9 months of depreciation was there already. This one I am multiplying with 9 by 12 once again, because it was already 9 by 12. It's not a full year figure that I'm minusing from 288.45, then getting a 9 by 12. Rather, I'm multiplying or reducing a 9 by 12 figure from here already. So in order to balance this problem out, what I have to do, this 288.45, I have to first get the 9 by 12 of this, because I want 9 months of profit from this thing. Then from that I have to reduce down, what is that, let's put it another color, what is that, minus 1.5 depreciation. So I can reduce down the depreciation from 9 months profit. So if I take full year profit and minus out only 9 months depreciation, then get the profit over here, then multiply it with 9 by 12, this doesn't look right. So what I have to do, I will make this into 9 by 12 minus 1.5. So problem is sorted. So this subsidiary's profit, I will make it this way, plus into 9 by 12. So now what happened, I have 9 months profit, and I have 9 months profit means this one. Okay, so I'll just remove this thing. Now I have 9 months profit, and I minus out 9 months of depreciation. Done. Does my story end over there? No. What do I have to do with this blue color thing? Earlier I pulled this expense out from my profits to get the adjusted profit, but this does not vanish out. I have to add this back over here. This expense should come back into this thing. So when I take this expense back into this thing, reduce finance cost, the thing that I removed earlier, I pulled out earlier, I'm just putting it back in its place. So this is equals to minus 1.5, and this is equal to minus 5. So what will be the sum of these numbers? 209.8375. What is this thing? This is adjusted subsidiaries profit. What do I have to do with this? Subsidiary is incorporated with parent Peasant company of 85% and 15% of NCI. So out of this adjusted subsidiaries profit, 15% of that will go for NCI. So 31.47563 is the amount that will go to NCI. So how about parent? Parent will be equal to, oh, this is TCI, sorry, wrong column. NCI will be equal to 15% multiplied by 209, this one, and parent will be equal to the original profit after tax that you have over here minus whatever is for NCI. Whatever is for NCI is for NCI. Remaining for the entire company, that is parents 100%, 85% of subsidiary, and 35% of associate. Everything is for parent. So all that remaining figure will go for parent. This is how you have to do the split over here. And now about the TCI part. What is coming extra from profit after tax to TCI? There's only a revaluation over here, and that revaluation is for whom? That revaluation is for parent. So either you can do one thing, you can just add that 2800 to this answer and get the final solution, or you know that NCI is anyways not changing because nothing for subsidiary is happening after that. So the same 31.47 will come up over here, and the total TCI minus whatever is for NCI, that balance will come up over here. Now if you look at the difference of this one, that will be 470 minus 467, that is basically 2.8. That 2.8 is this one. So basically you're just adding it to the parent, and NCI you're keeping as it is. All right, so that was the final solution for this one. And with that, we are done with our 17 marks of consolidated SOPL. So hope you followed completely with the calculations and everything we did over here. If in case you have not understood anything, just do rewind back, watch it once again. Cool. Now we have a 3 mark question left in this. That's going to be a piece of cake. Now we have some small paragraph over here. Peasant Company is a publicly listed manufacturer of food packaging materials. Peasant Company has been implementing sustainable practices in its business operation and aims to further integrate sustainability into its business activity to address growing environmental concerns. However, company is not yet familiar with IFRS Sustainability Standard 1 on the general requirements for disclosure of sustainability related financial information. Okay. Provide a brief explanation for of IFRS. No, nothing is there from here I have to do, so I'll just move it. Provide a brief explanation of the IFRS Sustainability Standard 1 general requirement for disclosure, and always be careful with the conjunctions in the question. When they have given and, it means I have to talk about this part and whatever is coming after this. So I have to split the marks accordingly. So first I'm going to briefly explain what is IFRS standard S1, then and its importance to peasant company and its stakeholders. So again and is there. So I have to talk about the importance to peasant company and importance to stakeholder. Since we have two and over here, the question is split into three parts already. The marks is for three. So basically I can just allocate like this: 1 mark for telling what is sustainability standard, 1 mark for telling what is the importance for peasant company, 1 mark for telling what is the importance for stakeholder. Any stakeholder I can take up. So let's start this. So first paragraph, what is IFRS S1? IFRS sustainability, I can just copy paste from here. IFRS sustainability standard 1, general requirements for disclosure of sustainability related financial information. Now what is the standard? This is what I have to say. Emphasizes on the fact that companies following IFRS are supposed to disclose matters related to their risk and opportunities with respect to sustainability matters and its impact on financial information. So what was the idea? IFRS S1 is saying that companies, if you're following IFRS, as per the sustainability records or as per sustainability standards, you're supposed to disclose certain things. What you're supposed to disclose, main thing is the company's risk and opportunities that they have related to the sustainability matters, and what would be the impact on its financial information. So along with SOPL, SOFP, along with the normal financial statement, they're supposed to disclose this as well. So 1 mark is done. Next thing, what is the importance for peasant company? If they are following with IFRS, let's say they are, it's mentioned over here, they are listed company, publicly listed company. So one thing, when they are disclosing things properly as per IFRS, they could be meeting the listing requirements if it is part of their country's rules. They are improving their transparency, and hence because it's a public company means they have to be transparent to whatever they're doing, whatever future values they're trying to create. So they're being transparent to the stakeholders as well. So from that point of view, transparency is also there. They can meet the listing requirements as well. Okay. But I don't know if it's part of their listing requirements, so I can just put it up over there. Considering that Peasant Company is a publicly listed company. If IFRS S1 disclosure is part of their requirements to maintain the listing, appropriate appropriate disclosures will help the company in maintaining their listing status. What else about transparency? We told adequate disclosures about 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 sustainability related matters will help in staying or will help in improving the transparency of the company to its public stakeholders. Okay, so we told about 2 points, and that's 1 mark over there. What is the benefit for stakeholders? Okay, before writing, let's just brainstorm this. What could be the benefit for stakeholders? Improving transparency means stakeholders gets to understand better about the company so they can make their investment decisions properly. Yeah, they can invest into good companies that are disclosing properly, and into they can back out from companies that are not disclosing properly, so investment decisions get better. So you can write that improving transparency in disclosures regarding sustainability sustainability related matters will help in gaining the trust of stakeholders, attract potential investors, and also help the investors in making informed decisions about their investment into the company. So partially about attracting investors and gaining trust and all, this is benefit for the company again. The only point that I've wrote over here about importance to stakeholder is this thing: they can make informed decisions over here. So this is all pretty much, importance for the company specifically. This is importance for the stakeholder, but again it's like a mutual thing, so altogether you're going to be marked for 3 marks. It's not like every minute point they're not going to check over here. So with that, we're done with the 3 marks, and with that we're done with our 20-mark question for section C. Hope you have followed with this question, and hope you have seen all the tricks that we do with the numerical question, how we sorted out, the splitting part specifically. That's something that most people get confused with the consolidated SOPL. And when an intercompany loan is there, how we deal with the finance cost. Hope you have understood the explanation of why we add and subtract the figures. Hope that is also ready. Hope you have understood how do we deal with the associates, how we deal with one company at a time when we're doing the calculation. Hope that was also clear. And hope with the theory question, this is also clear about how we split the marks. First, brainstorm the idea about the marking scheme that could be there in that particular question, how we have to focus on the conjunctions in the requirement, then address every part equally so that we don't lose out any marks. Most people, when they see this IFRS S1, what they might end up doing is they'll see that, okay, this is IFRS S1 question, this is for 3 marks. Whatever theory I've seen from the textbook, I just have to write it over here. If you do that, you're going to get only 1 mark. Why? Because you're only addressing the explanation of briefly what is IFRS S1. You're not addressing how it is going to benefit Peasant company. You're not addressing how it is going to benefit the stakeholder. So it's very important that you address every part in the requirement to get full marks in that question. It does not require a lot of effort to score that mark. It only requires some careful attention to what is there in the requirement. So be careful. Conjunctions always have to be, you have to keep an eye on that. So hope all the tips and things were helpful from this video. We have more to do from the question paper. If these videos were helpful, and if anything specifically from this particular solving helped you out, Make sure to let us know through the comments, and do share these videos to your other ACCA buddies who are preparing for their FR paper as well. See you in the next question.